For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Then we'll be talking about the first 100 days, Trump's impact on your finances. Then annuities. Do you really need guaranteed income in retirement? And finally, the 5 biggest threats to a successful retirement and how to overcome them. My name's Jeff Shade, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from 2 places this morning. It's Randy and Jake Floyd of Floyd Financial Group. Hey, Randy, welcome back to the show. How you doing today?
Doing very well, Jeff. How about you?
I am doing fantastic, thank you. And Jake, how's this Saturday morning finding you, my friend?
I'm doing great, Jeff. Thanks for asking.
Glad to hear that. Hope everybody else is having a great weekend. Tomorrow is Mother's Day, celebrating the second Sunday of May, honors mothers and motherhood out there. So happy Mother's Day. If you haven't gotten your wife or your mom anything for Mother's Day, you've still got probably, I don't know, you've got 10 or 12 hours in order to pick up something at the supermarket or whatever you want to do. Anyway, that is that. Let's get started with what's going on in the world today, and we'll talk about current events. Jobs report came in. What did the jobs report tell us, guys?
So the jobs report, people are always looking to, hey, what's being created? And it's a gauge of how the economy is doing. And the number came in stronger than people would have thought. Now, we always do have revisions to these numbers. So who knows what the revision will be? But at first glance, it looked pretty good. And people were a little bit perked up by that. Unemployment still remaining at 4.2%. So it's higher than it's been of late, but historically very, very low still. It just shows that the American economy is pretty resilient still.
And jobs in some sectors outperformed others. What are some of the sectors that really did very, very well?
Yeah, healthcare continues to outpace, which I guess stands to reason in a lot of ways. You know, healthcare is not going to contract as much as other things because people still get sick and still need care no matter what the price of things, right?
Right, exactly. Well, I understand healthcare is also recession-proof to some extent unless AI takes it over. What do you think about that?
Yeah, AI has certainly been in the news a lot, and we're going to talk more about that probably later. But AI is going to be assistive looking forward in medicine and things. And the AI thing, and we've talked about this before on here, in many ways scares me. And at the same time, it's exciting. And the challenge we always get into is anything that's great can be used for good. Right. Or bad, mm-hmm. And so we know there will be some bad actors out there. But overall, I think AI is going to help us with medical procedures and things in the future.
That's right, Randy. And now with AI, you can simply chat GPT, whatever your illness happens to be. It'll give you some advice. It may not be the right advice, but it'll give you something. I think for the time being, there's no substitute for a human doctor. But if you are going into healthcare, a nurse practitioner is a great way to go. Median salary of $126,000. That is the number one best job in America right now in healthcare. Let's talk about inflation a little bit. Where do we stand at this point?
So the inflation rate, I haven't looked at it. Jake, have you looked at that number?
Yeah, so inflation was actually negative over CPI and PPI, which is a couple of weeks ago. It kind of depends on what inflation metrics we're looking at, but really inflation is kind of gone in a lot of ways. And that's Trump's big gripe with Powell and why he doesn't accelerate the reducing of interest rates is they're worried about inflation and there really isn't any inflation. Trump's worried about jobs and the economy and things like that. And interest rates do need to come down at some point, so we'll see how all that shakes out. But yeah, as far as inflation's concerned, there's really not a lot of inflation going around. We got gas prices falling, we got egg prices falling, we got everything else really is either steady or falling a little bit.
The other thing, Jeff, everybody's concerned about the tariffs, of course, and that's something that we probably need to address here right quick. A lot of people are saying, I wish that Trump would have come out with a metered plan saying, hey, we're going to increase tariffs this much on so-and-so on such and such a date, and then a little bit more if they don't acquiesce. And a lot of people say, why didn't you just have Congress come out and help him do this stuff? Well, we know two things about Congress. If you really want to get something done, you won't.
So don't ask Congress to do it if you want to get it done, for sure.
Yeah, if you want to make sure it doesn't get done, take it to Congress. But anyway, so we know that there's been lots of past administrations that have wanted to do these cuts and really realign things, but anytime they tried to do it through what we would call, what has become, I guess, the normal channel, it just didn't work. So we knew, and he knew, he had to come out with a sledgehammer and just break it up and get it going. And I got to tell you, while yes, it's been a little painful, it's been a little bit messy. I had some people in here a couple of days ago that I was visiting with, and I said, it occurred to me that if you're going to go out and you're going to plant a field so you can reap a harvest, what's the first thing you have to do? You got to plow the ground and get rid of the weeds and get it ready to accept seed. And I think that's exactly what Donald Trump has done with these tariffs. Now, this may be a little bit messy for a while, but I think in the end, this is all going to play out exactly the way that he wanted.
And talking about tariffs, the latest tariff I've read about is that Trump wants to put tariffs on movie production or film production or television production that is not done in the United States. I'm not sure that who we would tariff, but what do you think about that? That's a new one on me.
Well, I think what's interesting about that, and I was watching, I think it was last Tuesday, I was watching a little blurb on that. There was a guy on CNBC talking about the fact that what's happening is these countries, governments are taking subsidies and subsidizing people to pick up, move a whole production team and everything to another country, and they're giving them so much subsidy there that they can't even compete here in a local studio in Hollywood. So I think they're right. They're going to have to, anytime you have people that are just engaging in unfair trade processes, like just imagine this. What if, this will kind of bring it home for people, what if we at Floyd Financial Group were able to pay every client that walked in our door $5,000 to come in and sit down and talk to us? Do you think we'd have some people lined up outside the door? Well, of course we would. But that would be an unfair trade practice because not every other financial planning firm could pay somebody $5,000 to come and sit with them. So it's just one of those things that, again, it's just more of what we would call unfair trade practices across the gamut of business in the world right now. And so we've got to get this playing field leveled.
Right, and Trump wants a 100% foreign film tariff on these films that are done overseas. I'm not going to say overseas because a lot of these productions are done in Canada. From my misspent path, I still have a lot of friends and people that I know who are still in the film and in the television industry, and they go to Vancouver to shoot a lot of these movies. As a matter of fact, right now, in the next month or two, some of the people that I know will begin doing some of these Hallmark movies that you see at Christmas time. And they're all done in Vancouver because the government subsidizes those productions, and it's just cheaper to work up there. So, yeah, I would agree completely that that is something that would be nice to be brought back to this country, because there are many people in the entertainment industry that I know that are right there in Hollywood who do not move to these other parts of the country that are going starving right now.
So apparently he was meeting with John Voight, who is kind of the guy that one of the three actors that Trump dubbed his, what did he call him? The liaison, if you will, of Hollywood. So you had Sylvester Stallone, John Voight, and Mel Gibson. And so he had a meeting recently with John Voight, and this was a few hours or something after that he proposed this. So I have a feeling that, first of all, John Voight's been around the movie business for a while at this point. Yeah. So he knows the game. He knows what's going on. So I think Trump is listening to wisdom there. And the United States topography and geographic location allows for shooting of all kinds of movies. Maybe not things like Lord of the Rings, where you need some kind of a mythical looking area, but pretty much everything else you could find in the U.S. if you really wanted to. But like you said, those unfair trade practices, this is just another example of that, where the U.S. has been taken advantage of, and we've just sat there and taken it for 30, 40, 50 years, and we're just not going to take it anymore.
Yeah, and to your point about shooting in the United States, I remember MASH was shot about 9 miles from my home in California, and Topanga Canyon there, it doubled for Korea just fine. Talking with Randy and Jake Floyd of Floyd Financial Group, and let's continue to talk about tariffs a little bit. Chinese companies are now moving to Texas, Nevada, and other states in the United States to avoid Trump's tariffs. Do you think that that is a way to get around these tariffs?
Well, I find that interesting, and you have to be careful. I mean, it's great that they want to come over here and build a plant and manufacture stuff, but I want to make sure that those people are properly vetted.
Well, yeah.
They're here legally if they
Exactly.
come over and do that sort of thing. But I think that would happen. But what we're really going through here and getting back to the tariffs and all that, it's just a way of realigning global trade. And we really went from where, if you think about it, Jeff, prior to probably about 40, 50 years ago, we were manufacturing everything here and doing everything great. And then we found out that these other countries were willing to work for less. And so we shifted things over there, started buying over there to get a competitive advantage. And then it's just run the gamut now to where it's at the end and we have to have another reset. So I just see it as a means to an end. Again, I don't think that at the end of the day, Trump wants to necessarily harm any of these economies. All he wants is a fair shake. That's why I said reciprocity. Let's do that. So I think that tariffs looked at as a punishment is not really what it's about. It's about, hey, how do we get you guys to the table to negotiate a fair trade deal?
Yeah, and some of these companies are setting up shop in places like Dallas, Houston, and Reno. If you bring over Chinese people and they're working in these companies that are in these places in the United States and they're still making a couple of dollars a day, I don't know how that's going to work because you certainly cannot survive in the United States on that, so they'll have to pay them more. We'll see how this all works out, but I thought, boy, they really are thinking of ways to overcome these tariffs. And then finally, Warren Buffett is at the end of the line for Warren Buffett.
Yeah, it was kind of shocking. Of course, we all knew that one day this would happen. I think, is he 94 now?
94 years
old.
old.
94, and Charlie Munger, his partner in, what would we call it?
Crime?
Crime?
Crime. I think that's the word you're looking for there, but
his
no.
partner, his collaborator in investment and business building, died 2 or 3 years ago. We're watching that pretty closely. And here's the thing that we talked about even yesterday or a couple of days ago. Jake and I were talking about the fact that people really believed a lot in Warren Buffett, more so than in the companies he's owned, because the company's underlying performance versus the performance of the holding company, Berkshire Hathaway, which owns the Symetras, the Geicos, and Apple, and all those things that he holds in his portfolio, he's actually outperformed all of those underlying assets, which shows you the belief in Warren Buffett. And as he steps down, while I'm sure Mr. Abel is an able body, that's his name, right? Abel?
Yep.
Greg Abel.
I'm sure he's able, or Warren wouldn't have put him in place, but I do think there's been a fair amount of confidence shaken short term.
Well, Warren Buffett's done a great job. Berkshire Hathaway shares have skyrocketed 5,502,284% since 1965, compared to the S&P 500, 39,054% during that same time period. So, job well done, Warren Buffett. Welcome to the fray, Greg Abel. Talking with Randy and Jake Floyd of Floyd Financial Group. Our program, of course, called Show Me the Money. We're having a great time here talking about current events. If you'd like to get in and sit down with Randy and Jake at Floyd Financial Group and talk about how current events may affect you and your portfolio, your journey towards a confident retirement, we invite you to give us a call right now this morning, 417-889-7233, 417-889-7233. And request your Floyd Financial Group financial review. Again, it's a chance for you to ask questions. A casual environment, 417-889-7233. No cost, no obligation, no judgment. Make that call this morning, and you can also find out more about us online at floydfinancialgroup.com. Randy and Jake, time for a break. When we come back here on Show Me the Money, we'll be talking about Trump's first 100 days in office. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about Trump's first 100 days.
And Randy, since FDR, the first 100 days of a presidential term reviewed as a benchmark for accomplishments, now, President Trump's second term is bringing a whirlwind of changes. Whether you love or you hate what's happening in Washington, or maybe some of each, there are some financial opportunities that you can use to your advantage if you know where to look. So let's start off with probably the first thing that comes to mind when you think of Trump's first 100 days, Randy or Jake.
Well, he took a wrecking ball
Yeah, that's right. Boom.
with him as a weapon to start with. I think a couple of things. While yes, a lot of presidents have come and gone, and I can't really sit back and think about. I've been on the planet a few decades now, and I can't think about a presidency really where we have had so much. What would I call it? I don't want to call it turmoil. It is that.
Well, change.
But, yeah, let's just call it change
Okay.
and proposed change that have been really kind of hard for a lot of people to accept. I don't remember another time like this. But I will tell you this, too. He has tackled more things at once than most people can juggle. I mean, I'm just telling you, it's been actually kind of fun to watch.
Well, and stuff that other presidents wouldn't dare to have even talked about, let alone jumped and tackled.
Right, exactly. But, it's caused some challenges across the markets. You saw markets go to an all-time high on the S&P 500 the 18th of February at 6147 and a little change. And then we saw it fall back down to 4,800 and a little change. And now it's back up in, in the 5,600 range, so we're probably down 8% or so from the high, which really shows a lot of resilience. And we've been watching the earnings and things come in from a lot of these companies. And the earnings, for the most part, have been pretty solid. A couple of things that people are concerned about when we look at the markets is, well, there's a lot of pull forward trying to get ahead of tariffs. So one of the interesting things I thought was funny, and I think our audience will think this is funny, is I was reading a deal about, Temu, and was it Shein or Shein?
Yeah.
Say that other one
Shein,
was
I believe.
the other one that was using the de minimis rule. That's $800 or less that shipped across that had no duty or no tariff of any kind. And of course that closed up. And one of the comments I was reading was this guy said, well, this is going to wreak havoc on all of us poor people. And he said, so to fight this, I'm buying a 2-year supply of all the things I would normally get from Temu. So I'm sitting there going,
What?
yeah, I'm sitting there going, now let me think about this just for a moment. It's kind of like saying I can't pay my mortgage, so I'm going to go ahead and pay 2 years worth.
Okay.
That makes no sense whatsoever, which shows you some of the mentality around what's going on there. But basically, too, they talked about since in the last 3 or 4 years that Temu shipments, those $800, those de minimis shipments and stuff, had increased 900%.
Wow.
And now they're effectively out of business because we got a 145% tariff on those things.
Wow.
And it's kind of like Scott Bessent said, our Treasury Secretary, he said, the American dream is not to buy cheap products.
Yeah.
And I agree with him. The American
Yeah.
dream is to be able to build a business and build a life and thrive, right? Again, I just can't wait to see how it shakes out.
Well, I'm a tool guy, and I buy a lot of tools because I use them and I like them. And, Craftsman has been a brand, an American brand that's been around for a long time. My grandfather used those tools, and I sort of try to buy some Craftsman tools when I can. But then there's Temu, and I think about the tools, and I don't know. I've never bought anything from Temu. I would think that that's pretty cheap. I mean, I will sort of go to a Harbor Freight once in a while and pick up something if it's something that I'm going to use once or twice. I don't need it to last for 10 years, something like that. But yeah, Temu, I have no experience with whatsoever, but I guess I'm not going to have to worry about it much longer, am I?
Maybe not.
That's right. Shaky markets. I mean, people do talk about the markets have been shaky, but consider this, 23 and 24, 20% growth each year. So the market can still be shaky, and over the past years, we're still up on that. Shifting winds on ESG, environmental, social, and governance as an investing principle. What do we need to know about that, or do we need to know about that?
You take it over to the garbage.
Yeah,
and you
take it over
throw
to the
in there.
garbage. And,
No,
or
you go.
as Kevin O'Leary would say, take it out back and shoot it.
Mr. Wonderful.
So here's the thing, okay? Yes, I mean, do we need to try to protect our planet and do things that are right for it? Well, yeah, I think so. And everybody has a realization of that. But do you break the back of businesses and economies in the process of doing that? And when you look at the people that were really propping up the ESG side of things, they were not really, how would I say, the most educated in finance.
Mm-hmm.
They had this, and ideals are great things to have. Ideas and ideals, meaning, what's the idealistic view of this, are great to have. However, the idealistic views are sometimes very difficult to realize, especially in the short term. And I just think that they got their cart way before their horse on ESG. And we've seen a great great rolling back of that over the last 2 years.
And in the next couple of years, I think investing in those areas is going to be a pretty risky move. Tax cuts expiring or not, we haven't talked about that a little bit. Is there anything new on that front?
Well, I know that that's one of the things that they've been talking about. Our speaker says he'd like to get it done by the end of May, I think. And then there's some other people saying it's more realistic to get it done by July. I don't know. I mean, it's something that we definitely need to do. A lot of people don't realize if the 2017 tax cuts and things go away, it is going to be a pretty good tax increase on people, which is going to thwart new investments because people are just going to have less money and buying of things, which will push us closer to zero GDP. So also, the corporate tax is part of this thing that we would like to see go from 21 back to 15. So that's kind of what's at play there. And of course, the one big beautiful bill to get it all done at the same time is what we'd like to see. But I don't know. It's going to be interesting. But Speaker Johnson seems to think they can get it done, and I hope they can.
I think personally that we're going to be talking about this issue till we're blue in the face over the next 2 or 3 months as this unfolds. I have done a lot of thinking about this topic, and I think the two big things that are on the chopping block that are big question marks in people's minds is, are we going to have taxes on Social Security? That's far and away the number one, right? Because he's mentioned over and over, and including on his tax plan online, you can still see it says, eliminate federal income tax on Social Security. Number two is no tax on people under $150,000 a year in income. So that one's a little more controversial because we're like, well, are we really going to let all those people not pay any taxes? If you do the math on it, maybe it costs $200 billion a year in tax revenue. But then you get to just lop off pretty much all of the IRS. Every corporation that has a huge payroll department or accounting department, they're going to get to fire 80% of those people. It's going to drive profits. It's going to drive creation. It's going to drive shareholder returns. On average, it's generally accepted in economics that every dollar that somebody has to spend, it's somewhere between 4 and 7 times that it works its way through the economy. And if that's true, and you kind of extrapolate the math, you could potentially even offset that tax downfall, if you will, by simply being that much better off and being more efficient and less red tape. I mean, when you think about how ridiculous the tax system is, and that we spend 3 months a year out of 12 months calculating how much we owe the government. Yeah. I mean, what a humongous waste of time. So, I mean, I could definitely get behind that, and I would not rule it out as a possibility. It's also an amazing 3D chess move by Trump, because what's going to happen when that comes across Congress, right, is you're going to have all these Democratic senators, and they're going to be forced to have the choice of, I agree with Donald Trump, and I agree with his tax policy, and I think it's a good idea, which they won't do, right? Or they're going to vote against it, and a vote against all their constituency who doesn't want to pay taxes and wants everything for free. I mean, it's a brilliant 3D chess move that probably leads to an overwhelming Republican conservative victory in 2026. So it's going to be fascinating to watch it happen. I have absolutely no idea how much of that's going to happen or not happen or anything, but it is going to be wild to watch it unfold.
So, Randy and Jake, what can our investors and our listeners to this program today do with all this information that we've talked about with the first 100 days? Should they do anything, or should they just stay the course and stay invested?
Well, get your favorite brand of popcorn.
Okay.
Put it in the microwave. I would say that right now, there's probably not a ton to do. Sometimes the right thing to do in investing or in your planning process is to wait for data, wait to see what's going to happen here. I don't think that today is a great day to just jump all in and buy, but I also don't think it's a great day to jump in and sell either. I think we just simply don't have all the information we need to make those judgment calls yet, but I think those answers are coming over the next weeks and few months here, and then things are going to become a lot more clear. Again, Randy and I both have said that over the medium term and the long term, we both think are going to be very, very good, both market-wise, economically, and just people's prosperity in general. It's the short term that's very unclear right now, because whether you like him or hate him, we basically have one guy kind of stirring the pot and doing what he thinks is best. Now, he was elected to do that, And I'm personally willing to give him the latitude to continue to do that. But because it is just one person, he can wake up on the wrong side of the bed or the right side of the bed and change his mind at any moment. That's not a great environment to make long-term decisions in. And so I would just hang in there like a hair in a biscuit, as Grandpa Floyd would have said. And, just pay attention to what's happening, though, because fortunes are going to be made and lost here over this little bit where people are convinced Trump's going to destroy them. Those people are going to miss out on the opportunity of a lifetime. But the people that think it's just going to be straight up ride from here are also probably in for a surprise. And I think that we just need to be careful and be thoughtful and maybe just wait for more information before we make any really big moves.
Yeah. I think also looking back over our shoulder, if we were to look back to the financial crisis in 7, 8, and 9, I think that was really probably a bigger fundamental problem than we're looking at today. And we know what happened there after we put $3.5 trillion of quantitative easing in 10 through 13, basically. After the low of March 2nd, 2009, the market rallied 425% in 11 years. Now, this time through, we printed $7 trillion under the Biden administration. According to the latest numbers I have, there's still like $6.5 or $7 trillion in banks and money market accounts. As interest rates come down, oil's being pushed down. As inflation comes down and interest rates come down, people are not going to be happy with 3% when they're used to getting 5%, and that money's going to flow back to the market and to these companies.
There is going to be a point where the smart money, quote unquote, the very large investors are going to wake up and go, these stocks are way too cheap. And when they do that, when they start moving in, that's going to move markets big and fast. We definitely don't want to be just totally uninvested here because we could get left behind. But we also don't want to be super over our skis bullish either, because it may be a little bit early for that type of sentiment. So again, we want to be prudent, we want to make good decisions, and we need to execute our plan. Hopefully you have a plan. If you don't have a plan, that's what we're here for. If we have a plan that works in all types of weather, then all we have to do is stick to that plan. We don't have to make these huge moves and go, well, I'm all in, or I'm all out, or I need to, wait on the sidelines for 37 and a half days and then put it all back in. There's a plan that you can have set up. And if we execute that plan, it'll work in all types of financial weather.
Talking with Randy and Jake Floyd, Floyd Financial Group. We're talking about Trump's first 100 days in office. And as Jake said, I think the key to all this is to have a plan. If you do not have a plan, maybe you have a plan someplace else, you want us to take a look at that, call us today, 417-889-7233. Request your Floyd Financial Group retirement review. No cost, no obligation, no judgment. Get that plan started today. It's not going to cost you a dime to make that call. 417-889-7233. Leave your name, telephone number. Ashley will call you back during the week and set up a time for you to come in and sit down and talk with Randy and or Jake here at Floyd Financial Group. You can do it by phone if you'd like as well, but don't forget to make that call and do it today. Once again, that number, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, time for another break. When we come back, we'll be talking about annuities, the good, the bad, the ugly, and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in segment number 3 today, as Jeff would say, the third half of our show.
And that's right.
We're going to talk about annuities and their role in financial planning. And do we really need guaranteed income?
Yeah, I would think as you get older, Randy, and correct me if I'm wrong, that I would think that I need guaranteed income. I've got Social Security. Now, I'm lucky because I do have a pension. A lot of people don't have pensions, but I don't know. Social Security is guaranteed to a certain extent. I would think that I do need guaranteed income, but still, that is a question right now that's being thrown around. Are annuities the best choice for guaranteed income? What's your opinion on that?
So I won't talk about it being the best choice. I will talk about it being a choice. And I think there are annuities that are good, and there are annuities that are not so good. And when I say that they're good and not so good, first of all, let's talk about what an annuity actually is. It is an arrangement or a contract between you and an insurance company. Most pension plans are issued and run by annuity companies or insurance companies. And the reason they do that is they are able to guarantee income for people over a lifetime or maybe even a couple of lifetimes, depending on what the situation is for you and your spouse or you and your significant other. So is it one of those things that everybody needs an annuity? And does everybody need 100% of their money in an annuity? Absolutely not. So I think it's something that each person has to really sit down and evaluate. But here's what it really boils down to, I think. Here we are, we grow up. We're born, we grow up, and we live to be 50, 60. Do you expect to wake up tomorrow morning?
I
Of course
do
you
hope
do.
so. I would expect to do just that, yes.
Of course you do, because if we didn't, we'd all be sitting around on pins and needles all the time. But we've been doing it for 50, 60 years.
Right.
So we expect we're going to wake up tomorrow. It's the same way with our job. We worked for 30, 40 years, and we had an income that we could count on. And we always felt like with our skill level and the fact that we're alive and breathing and can perform so many movements per day and think about things for companies and get paid, that we're always going to get paid. And then all of a sudden, if we aren't careful, it's kind of like at retirement. We walked up to the edge of this cliff, and it's the Royal Gorge, and it's 2,000 feet to the bottom. The wind blows, and it's kind of cold, and they go, where's my income going to come from now that I've retired? and we haven't really thought about it a lot until we get there sometimes. And so we also all of a sudden have to say, my sister said it best, I'm on a fixed income. What do I do now? Well, are you or are you not on a fixed income? And are you subject straight up to what markets will give you on a given day, whether that be interest rates or whether that be the stock market? And so annuities are a place, it's kind of a backstop, if you will. And many times, many advisors will say, well, let's use this as a baseline. Let's take our Social Security and a pension, if you have it, or some of our investments and put them into an annuity contract where we can have some guarantees that we know we can always keep the wolf away from the door. And then we'll use our extra money or our surplus money that we can derive from our investments, maybe from a stock market or something maybe a little more risky, to give us all of our fun money. And that's kind of one way to look at it. But everybody's situation is totally different. And so it's one of those things where as people go out and they write these articles and they try to give us a blanket answer, there isn't one. What's right for you is different than what's right for me because we have different ideas of what retirement looks like, right? And how much money we need to spend during that time. So some of the annuity contracts that are out there, they're too expensive. Like a straight up variable annuity with an income rider, sometimes will cost you 3% per year just to own them. Well, that's a big, big drag on investment performance over the time. Now, will it guarantee you an income? Yes. Will it guarantee you your principal on that variable annuity? No. Then there's some combinations of those things. There's fixed annuities that look kind of like a CD where they'll pay you a guaranteed interest rate for a period of time and pay you a monthly income off that. Then we have the hybrids, which are fixed index annuities, which track an index like the S&P 500, and you get part of the gains there. We can never get 100% of the upside, which is sometimes why the really stock market zealots would say, you never want an annuity because you only get part of the gain. Well, the thing that they forget is you don't take any of the down either. So a rule of thumb would be, I would say use it kind of like a stock and bond portfolio, which the old retirement portfolio was a 60-40. Many times the annuity can replace the bond portion of that. The other thing is now we have these new things called RILAs, which are registered index linked annuities, which don't give us 100% downside protection like the FIA or the regular fixed annuity does, but it'll give us a buffer to the downside where we don't lose money unless it goes down 15 or 20% in some cases, and yet we get a larger portion of the upside. So there's many, many different types of annuities, and I will tell you too that I think that there are many of these advisors that are maybe not as well educated in what annuities are out there right now, because if you work for some of these companies, you're stock and bond purists. And that's all they really know and understand, and they don't really take time. They just know, hey, annuities are expensive, too bad, they don't work, and it ties up your money and all the negative things. And there's even people out there that think today that, and it's possible for this to happen, but not likely, that once I put my money into an annuity contract, I can never, ever, ever get it out. And that's just not true. Or if I die early, my spouse gets nothing and my kids get nothing. And there are situations like that, but not very many. And we certainly, if we were to use an annuity contract, would never put people in a situation like that.
Well, one of the big knocks, as you said, was fees, and they can range from 1.5% all the way up to 4% or so. And if they're in a 401k, it's hard to determine what the fees are. But let's talk about the liquidity. That is the big knock on annuities, is liquidity. Something comes up, you need some cash. You really can't get at that cash, can you, or can you?
Well, you can, but you may end up paying a penalty to get it out, kind of like on a CD at a bank, only the penalties can be a little more stiff. And the reason is annuity companies, for them, anytime, or anybody that was going to do this, anytime you get a guarantee from somebody, you have to give something up to get a guarantee. You can't get the sky is the limit and a guarantee. Those two things just don't exist anywhere on planet Earth. It's like saying, I want 100 bushel per acre corn, but I don't want to plant any seed. And if a farmer wants more corn, what's the first thing they have to give up?
Well, of
corn.
course,
They got to put it in the ground, right?
Yeah, right.
So anytime that you have that situation where people are trying to maximize and minimize, you're going to have to take a little off the top and a little off the bottom. You just can't have it both ways. So when we look at sitting down with people and developing a retirement plan, what we're looking for is, okay, number one, what do you need income-wise? Number two, what is your tolerance for risk and volatility? And I have people come in and say, listen, man, if I lose 1 red cent, I'm a shambles and I won't eat and I'll lose 30 pounds. And then I have other people that come in, and that's the rare exception, but I'm just trying to paint a picture here. So they have the other people that come in sometimes, they'll say, I don't care if you lose it all, just make me a mint. That's an oxymoron, right? You really can't do that. So what our job here really is to learn what people need, what makes them thrive and feel good and able to sleep at night and fund their retirement the way they want to within reason. We can't just make it whatever people want, but generally people have fairly realistic expectations. But our job is to help people get invested right. We never put 100% of anybody's money in an annuity. We're going to have some liquid money for emergencies. Generally, we're going to have 3 to 6 months in cash. We're going to have some stock and maybe some bond investments, and we may have an annuity contract over there. In fact, many times we will, looking for the stability where we can get gains and yet protect when markets are down. And we try to build scenarios where when markets are good, we can capture 60, 70% of the upside, maybe a little more overall as an overall portfolio. But when markets are down, we only want to participate maybe 20 or 30% of the downside. So it's a little bit of a complex problem, but we work through it and we take time to explain it to people. And once they really had a chance to get underneath the hood and look at it with us, we generally get people going, oh, well, I see why you would do that now. And it's really pretty enlightening. And we love to have people sit down and really talk through it, because many times people have invested for 25 or 30 years. They know that they're invested in mutual funds in their 401k. They know that they might have some bond mutual funds inside there as well as equity mutual funds. But really, when it comes to stopping working and turning that into an income, it's hard for people to understand how to do that because things are always changing. If we look back over our shoulder, CD rates 4 years ago were 1%. Today they're 4.5. They were as high as 5.25 a year ago. If you could get long-term 5 years at 5 at one point, looking back over our shoulder. Now you're probably going to get 4.25 for 6 or 7 months because banks know that most likely interest rates are going to come down from here. So what we're doing is looking at all of these options and how they change from time to time, and looking at how do we build a portfolio that when interest rates are falling, how do we kind of skew things to the market a little bit more? Or when interest rates are going up, we know that markets tend to suffer when rates are going up. So how do we skew that back to the other side a little bit and keep this balance and keep people in the black, or, where they're not going to run out of money? It's not something we just set it and forget it. It's a living, breathing thing day to day based on what's happening in the world with markets.
Talking with Randy Floyd, Floyd Financial Group. We're talking about annuities. And Randy, we've mentioned before that there isn't just one annuity. How many different types of annuities are there out there? And once you've vetted these annuities, how many do you actually use?
Right. There's hundreds of companies out there that issue annuity contracts. And there are really strong companies and there's really weak companies and there's stuff in the middle. And the really strong companies sometimes are really strong because when you set up a contract with them, they don't like to share the wealth quite as much as other ones. In other words, they keep a little bit more of that upside. Then we have the other side, whereas we have these companies that are willing to pay you, man, and pay you. I mean, like, that is awesome. But what we know is they may not be able to support that long term. And so what we're looking for are the companies in the middle there somewhere that give us good, solid investment basis and payouts and upside potential against markets. We usually end up focusing on, somewhere between 3 or 4, maybe 5 companies that do certain things well. That's not necessarily just a static list. It changes as things change and as companies change, as time moves forward. Sometimes companies are in a position where they have a lot of excess capital and they're looking to buy business. And sometimes capital is a little harder to come by, a little more expensive, and they're not looking to do as much business. So it's something that we are always monitoring and watching. Bear in mind, too, that the only type of annuity that you give up total control over is an immediate annuity with a life payout. Now, that means that it's going to pay for your lifetime, and then if you die early, it's gone. Well, I will tell you, we just don't use those at all.
We don't like anything we can't change,
That's
and
right.
we don't want to take away options for our clients. Life is change, and regardless of what you think retirement is going to look like for you, I can promise you it'll be at least somewhat different. And so if we set the plan up on the front end and it has zero flexibility, that's a problem, and that's where people get unhappy. And so what we want to do is be able to change income as we go, be able to change risk profiles, whatever we need to do in the interim. We want to be able to have the options to do that. Not necessarily because we will, but a lot of life comes down to having the option to do what you want to do when you want to do it.
So, Jeff, I want to think about two things here. Number one, the equities market has always been deemed more risk capital, right? Whereas the insurance side of things, what do we buy insurance for? We buy insurance to protect us against things we don't want to happen. Equities, we buy hoping that we can invest in a company, a small amount, and that company will grow over time and produce dividends for us and make us more money. So when you look at it from that perspective, we have the safety side of things, and we have what I would call the risk asset side of things. And the balance of those two things, based on each unique client's perspective and needs, is what dictates. It becomes common sense, and when we explain it to people and they look at it, they go, oh yeah, that does make sense. It's just one of those things that it takes a little time and a little education to really get underneath what's happening. The one thing I love about insurance companies is they will do exactly what they say, but not one thing more or one thing less. And as long as you understand that going in, you'll never have any trouble. On the equity side of things, it's our job to help manage. We can't control the equities market, but to manage where money goes and where we think it's going and try to get there a little bit ahead. And if we think things are going to fall off, to maybe try to get there a little bit before to mitigate some of the risk.
Talking with Randy and Jake of Floyd Financial Group, we're talking about annuities. If you feel that an annuity may be right for you, you've got some questions, call us here at Floyd Financial Group. Set up your Floyd Financial Group retirement review to ask your questions about annuities. 417-889-7233 is our number. 417-889-7233. Call this weekend, leave your name and number. Ashley will call you back during the week at 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake, time for a break. When we come back, we'll be talking about the biggest threats to a successful retirement and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in segment 4, we're going to be talking about the 5 biggest threats to a successful retirement.
And we're going to breeze through these, guys. I think the first one is medicine and technology have allowed us to live a long time, something called longevity risk. Why is that such a risk to your retirement?
Yeah, a lot of times people come in, and it's kind of funny. It's not funny, but it is kind of funny. And we'll say, well, you're 65, you're retiring. We need to plan for you to live to age 90. And they go, I'm not going to live to 90. I won't even make 80. I might even make 75. Well, here's the thing. If you do make 85 or 90, you want to make sure you have some money, right?
Well, yes.
So you don't want to be there and be broke. But, it's been said that like 68% of people that retire are afraid of that very thing, that they will outlive their money somehow. And they say that that's worse than being trapped in a burning building. That's their second worst fear behind running out of money, And being trapped in a burning building is pretty scary to me to think about. But so, when we build plans here, we always are looking to build plans to 90 or 95 just to be sure that we're not going to have that happen. Many times when you see, like, I don't know about you, if I'm out perusing online, looking around, you'll see these things that will come up. How long does $1.5 million last in retirement? Well, that's a question nobody can answer.
As long as you
because-
let it.
Because, Exactly, as long as you let it. They don't have any idea about what kind of income they need or whether they're going to pull out of that $1.5 billion. But what they generally do is they take a time frame of 20 years is what they're going to tell you it's going to last or something if it doesn't grow at all. But the long and the short of it is every situation like that is different. You just can't, they're fishing is all it amounts to get some people to call them. But I just find it interesting that they would throw out that question. It's an incomplete question.
Talk about threats to your retirement plan. First one, of course, is going to be longevity risk, and that is living too long. And we do run these plans out to 90 years or so because you don't know. With technology today, you very well could live to be at least 90. Next one on the list is going to be inflation. Why is that such a threat? Why can't we account for inflation and overcome that problem?
Well, we've had a lot of varying rates of inflation since COVID, right? So we were at 1 or less for a very long time. And then we had COVID come along. We spiked up, I think, 9.9, 9.8 for a while. Then we've slowly ticked back down. The thing about inflation is people say, well, how do you prepare for and how do you account for a 9% inflation rate? So you ready for the answer, Jeff? You
No,
don't.
You don't. I was
You
going to say,
don't.
you can't do that.
And nobody can. I don't care who you are. You really can't plan for that much inflation. So what's one of the best hedges against inflation? The stock market has always been one of the best hedges. Now, not to mention the fact that it can be a stressful place when markets are down, but typically, looking back over the last 100 years, markets, yes, they have ups and downs, but they've always gone up, and that's a pretty good hedge against that. But the thing to think about is this. A 3% inflation rate means that every 24 years, you need twice as much money. So if you're retiring at age 65 and you live 20 years, you're 85, 24 years makes you 89, right? At 89, you're going to need twice as much money if you're living exactly the same lifestyle as you will when you retire. So inflation is very important to monitor, and we need to think about how we're going to manage that looking forward. Now, I will say this. Most people spend more money between 65 and 80 than they will after 80. And so you may not need a complete hedge against inflation, but that's why the Federal Reserve wants us to have maximum employment to keep funding Social Security and all those public plans, and only 2% inflation, so that it's only every 50 years you need twice as much money.
Talk about threats to your retirement with Randy and Jake Floyd of Floyd Financial Group. You know, with people living as long as they do, I would imagine that the last few years, you may need long-term care. That's the biggest thing that I think about. How am I going to pay for long-term care and increased health care costs?
Yeah, so, it's been said that after age 65 is when you'll spend 80% of your money on health care. So knock on wood, I'm in pretty good shape at this point. I haven't spent too much on health care, but you never know what's going to happen. A good friend of mine and client of mine, I had for a number of years, he didn't really have any family, so we had to find some people to help take care of him with power of attorney and all that sort of thing. I mean, here was a guy that was 5'10", 150 pounds, blood pressure of 120 over 80, no cholesterol, and he had a stroke.
Wow.
And he could never return home.
Wow.
So he's in assisted living now. He's in a pretty nice place, but it's $8,000 a month.
Yeah.
So you just don't know. So talking about this and having a plan as to what you're going to do is a crucial part of doing a retirement plan.
And there are a lot of misconceptions about health care and who's going to pay for that, particularly long-term care. People think, well, Medicare is going to pay for that. That's not the case, though.
No, generally speaking, Medicare is going to run out of benefit for you at about day 100. It could be as soon as day 20, depending on what your situation is. If you're rehabilitating, in other words, if you had a stroke or some event and you're getting better, you may have as many as 100 days, depending on what your plan is. After that, you're going to be on your own to figure out how to take care of your health care. So no, do not rely upon Medicare to do that. And if you have assets that you haven't done any planning with and you have those, you're going to be required to spend those down. Now, I will tell you, we need to have a conversation about that with each client. We need to talk about what your plan would be. Is it some type of insurance? Is it some type of a asset protection trust to help with that? Everybody's situation is different, but we can certainly help people navigate that.
So, Randy, someone listening to the program today, they're 60-ish. Let's say that they're 65. They do not have a plan for long-term care. Is it too late for them to get a long-term care policy? And if so, and it's too expensive, what does one do? How do you plan for these expenses?
Yeah, so at 65, I mean, it's going to cost a little more, but I would say that's probably the age where most people kind of wake up and say, hey, because like I talked about earlier, we always just think, hey, we're going to wake up tomorrow and it's going to be the same, right? And everything's going to be fine.
Yeah.
But one day it may not be. So is it too late to get insurance? No. Are there many different types of insurance? And do we have to buy the whole hog or just a partial? All those scenarios are out there. We just need to talk to each person and see what their situation is. And then we can use the appropriate tool or show them what those tools are and let them decide if it's something they really want to address or do they really want to go uncovered.
And Randy, you have talked on this program before about the 4 ways to pay. Can you briefly tell us what the 4 ways to pay for long-term care are?
Yep. Basically, the 4 ways to pay are out of the hip pocket each month, which most people are not equipped to pay $6,000, $7,000, $8,000 a month out of pocket. There's some type of insurance that you have bought, long-term care. There's different chassis. Some are just straight up long-term care policies. Some problems with that are escalating prices. There are life insurance contracts that help with long-term care by accelerating a death benefit. There's a combination of those two things. Then that's the insurance portion of it. Then there's the Veterans Administration, if you were a veteran that served during a period of war. And there's also some financial considerations we have to look at for everybody there. But that's something that's called aid and attendance that you might be able to get help with for home health care as well as skilled nursing. And then there's the veterans' homes that come along with that as well. And then finally, there's Medicaid. And Medicaid is an extension of Medicare that basically helps people to pay for nursing home, not home health care necessarily per se, and not assisted living. There's a very small benefit for assisted living potentially, but something you can do to structure assets where that you might qualify for Medicaid in the event you need skilled nursing.
So, Randy, the next threat to your retirement savings is going to be market volatility and sequence of return risk. I don't want to spend a lot of time on that because I do want to jump to the last one here because we're running short of time this week, and that is going to be taxes and a poor withdrawal strategy. How can we overcome those two threats?
Yeah, when we look at how we take income, we need to see what tax bracket each of those strategies is going to put us in. If you can remain in what today would be the 12% tax bracket for the Fed, and the state of Missouri is going to be somewhere between, depending on if you got a pension or not, if it's Social Security, because Social Security is not taxed anymore, and how much your investment income is going to be. Your Missouri state tax could be as low as 0 or all the way up to maybe 4.9%. If you can stay in the 12% federal tax bracket, which is basically up to, before you take your standard deduction of $30,000, $125,000, that's going to be pretty good. If you're going to get outside those, now we really need to take a fine-tooth comb and figure out a smart tax strategy beyond that. But when we sit down and we do your planning and we start looking at income, we can give you a good idea what your tax burden is going to be and how to do it more efficiently if we need to.
Talking with Randy and Jake of Floyd Financial Group, we're talking about the 5 threats, the biggest threats to a successful retirement, and they are outliving your money or longevity risk, inflation, loss of purchasing power, healthcare and long-term care, market volatility, sequence of return risk, and finally, taxes and poor withdrawal strategies. If you have questions of Randy and Jake about your retirement plan, you can give us a call here today, 417-889-7233. Request your Floyd Financial Group retirement review. It will not cost you a dime, and there is no judgment. There is no obligation. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake would just get started, then we run out of time. So for Randy and Jake, I'm Jeff Shade. Have yourself a great weekend. Happy Mother's Day. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.